All right, guys, I'm here to show you 8 reasons why you should consider refinancing. Number 1 is a lower interest rate. So how you work out if you're going to save money by refinancing is you've got to go your old rate. Now, let's say your old rate was 7%, and let's say your new rate is 6%. You go the old rate minus the new rate means you'd save about 1%. Now, if you save 1% and your loan is about $600,000, to work out the savings, you get the loan amount and you times it by the interest rate differences, in this circumstance 1%. So 600,000 times 1% means you'd save $6,000 per year in interest. $600,000 divided by 12, it is exactly $500 a month. Now, on a loan amount of $600,000, if you have a normal 30-year P&I loan at 6%, and you use that $6,000 that we just saved you, which is $500 a month, if you make that as an extra repayment, you'll save yourself $212,000 of interest, and you shave 8 years off your loan. That's reason number 1. Reason number 2 is to access equity. Now, what can I do with equity? And firstly, how do I even work out what my equity is? Let me show you. So let's say you've got a house, and let's say your house is worth $1 million. And let's say that your loan is $400,000, okay? To work out your LVR, you have the loan, and then you divide it by the value of the house. So 400,000 divided by $1 million means you are sitting at a 40% loan to value ratio. And what the difference here, this here is the equity. So the difference between what I owe and the value of the house. A good reason for people to refinance is they can access that and do things like renovations, we find. So some people want to put a deck at the back of their house. They want to put a pool in. They access their equity for renovations is reason number 2. Reason number 3 is what I love to do and help heaps of Australians do is buy investment properties. So what a lot of people do is they use their current house and they use the equity in it to cross-secure, we call it, to buy a second house, and they borrow 100% plus the fees from using the equity. Let me teach you how it works. So let's say you have one house, and let's say it's your own occupied property, and it's worth $1 million, and like the scenario before, you owe $400,000. And let's say you want to buy the house next door for investment. Okay, bank jargon for you. Owner occupied means the one that you live in. Investment is an investment property where you collect rent. Now, you got no savings. You got kids, you got school fees. You have equity and you have an income, but you haven't got any money to put towards buying another property. And even if you did, you probably want to pay off this one quicker because there's no tax benefits to have a mortgage on your house where there are tax benefits to have an investment mortgage. So a lot of people use their surplus money to pay this one off. So they often want to borrow 100% plus fees when they buy an investment. So when they buy an investment property for $1 million, there is usually fees, and the fees are usually around 50 grand on $1 million investment. So they need $1,050,000 to buy that property. That's over 100% loan. How do they do that? They cross-secure them. So the bank looks at them all together. Okay, so not individually, together. And this is sort of how it works. Assets, liabilities. Asset number 1 is my owner-occupied property, which is worth $1 million, and I owe $400,000 on it. You can play this at home as well, right? So work out what your house is worth and put your loan amount over here. Then you want to buy the investment property, and that's also worth $1 million, but I want to borrow $1,050,000. $1,050,000, all right? So what you do is pull out a calculator. I don't need one for this. That's $2 million of property. And this is going to be $1.45 million of debt. Now, as long as this next number is 80%, that's how you know if you can do it. So you simply go 1.45 million divided by 2 million. I'm at 72.5%. So basically, even with a second property, my debt is 72.5% of my value of my property. So that is reason number 3. When you refinance, you can use the equity to buy an investment property. Number 4 is debt consolidation. So for those who are playing along at home, if you've got a mortgage and you have got a credit card and you're paying 20% on that, or you got a car loan, you're paying 11%, and you have all this equity, what a lot of customers want to do is roll that into their mortgage. And let me give you a tip. Don't put it on a 30-year loan again. Split it into its own separate mortgage. So for example, if you have got a credit card and the limit of the credit card is 20 grand and you owe 20, and you got a car loan and there is 10 grand owing on that, Afterpay, Zip Pay, you name it. For this circumstance, let's say there's $30,000. Now you're going to save quite a lot of money because some of these people are paying 20%. So if I've got $30,000 of consumer debt and I'm paying 20%, that's 6 grand a year of interest. I could be paying 6 grand a year of interest for these things here. Whereas if it's on a mortgage, $30,000 times 6%, it's going to be $1,800. You save yourself like $4,000 by rolling into your mortgage. Recommendation though, don't put it over 30 years. Try and put it over 3 to 5 years. So if you, for example, have $400,000 on your mortgage, when you refinance, a lot of banks will just go, listen, make your loan plus 30, and now you owe $430,000. My problem with this is the following. You might be 5 years into this loan here, meaning you're already down to 25 years. And yes, it looks impressive having a really low repayment because the bank might stretch you back over 30 years. But the longer your loan term, the more interest you repay. I've done heaps of videos. Make sure you follow me on YouTube to see how I show you how having a smaller loan term can pay off your loan faster. What I would usually recommend is 2 loans, A and B. Keep your 400 grand loan as is, all right? And if you have got 25 years left to run, do a 25-year loan on this new loan. But for loan B, this consumer debt one of $30,000, try and do that one at like 5 years. Don't roll a credit card into a 25-year loan. Moral of the story. Number 5, of course, reducing your loan term. I've done a scenario up of the difference having a reduced loan term. Same loan term, $600,000. Customer 1 chose to do it over 30 years. If you get a $600,000 loan and you do 30 years, you'll be paying interest of $695,029. So this is a big reason people refinance. If they change it to a 20-year loan term, the total interest payable is $431,661. That's hundreds of thousands of dollars difference. And if you can afford to do a 10-year loan term, which is very hard, but if you can do it in 10 years, $193,348 is the total interest you'll pay on a 600 grand loan. Big difference. Another big reason people refinance is fixed rates. A couple of years ago, we got fixed rates as low as 1.99%. So a lot of people want to refinance when fixed rates are low. For those who are locked in at 1.99, you're still laughing because today's rates are 6.5%. You'll be saving a lot of money. So fixing is a big reason you can fix in this country from 1 to 5 years. That is another big reason people looking at refinancing. And to me, honestly, the last reason, which I think is one of the best, is relationships. If you're with a bank and you haven't actually got a relationship with your lender, you could be costing you thousands of dollars. So a lot of people refinance to build a relationship with someone because ultimately it's not a one-off transaction. The reason you want a relationship is you can actually call this person on their mobile. If you want to see where you're at, have you got equity to go again? Is your interest rate still competitive? If that person you got a relationship with is actually good, they will do all these things for you at least every 12 months. Your interest rate is no good. Let's look at refinancing. Did you know your house has gone up in $500,000 equity? There you guys have it. There's 8 reasons why you should consider refinancing.